Welcome to Mad Money. Welcome to Cramerica. My friends, hey man, I'm just trying to make a little money here. My job is not just to entertain, but to educate, to teach. So call me 1-800-743-CBC. Tweet me, Jim Cramer. Everybody's wringing their hands about how President Trump fired the head of the Bureau of Labor Statistics in response to that jobs report fraud. It's the kind of thing Wall Street loves to worry about. But you know what? Man, I take my cue from the market, and the market roared today. Dow gaining 585 points. S&P up 1.47%. And NASDAQ polling 1.95%.
House of pleasure.
It seems we all have an opinion about the president's somewhat rash decision to be diplomatic about it. But I think that misses the real point here. See, President Trump has done everything he can to strong-arm the Federal Reserve into cutting interest rates. And that labor report is the best evidence that the president's right. See, this is a W, a win for the White House. Take the win, for heaven's sake. The Fed's never going to cut rates if the job market's too strong. So this newfound softness is a huge positive. Hence today's terrific rally. And there is softness. Come on. Long-term interest rates have plummeted. Despite the federal government's enormous financing needs and supposedly inflationary tariffs, if they're inflationary, most Americans haven't seen it yet. Although the most serious ones, candidly, haven't really hit yet either. All the more reason for the Fed to cut. But in the end, whether you love Trump or hate him, the market clearly doesn't care one whit that he fired the head of the BLS on Friday. Stocks are showing extraordinary resiliency in the face of something that was supposed to be really negative, at least according to all the articles in both the conservative and liberal press. So many of the stocks that have been strong on Thursday and then got clubbed on Friday bounced right back today. Some of them stronger than when they fell. Now, some of that may be because the Fed has to cut. Maybe even before September. I mean, that's how weak the employment numbers are. But at the heart of the market's resilience as well, what do we think? The Magnificent Seven. Yeah, I know. After all of this, they're still the winners. You know what? We got to define winners right here. I like to look at growth. You know, I think growth is the most important determinant of higher stock prices. I make that point endlessly here. First, let's take them in aggregate. With 6 of the 7 already reported, earnings growth for the Mag 7 is expected to be 27.2% this quarter. The rest of the S&P 500, excluding the Mag 7, 7.5% earnings growth. Oh, that's almost 20 percentage points different. 20. It's incredible. And how about revenue growth? Mag 7 is on track to see 15.5% sales growth. The other 493, 4.5%, an 11 percentage point difference. In the world of statistics, that is simply blow away. You rarely ever see any one group of anything beat the S&P 500 so convincingly. How did they do it? Look, you conclude that the rest of the S&P is just a bunch of losers. Something that's not really true, but it does have a lot of losers in it. The other way is to look at the mostly magnificent quarters we've seen from the 7 themselves. So let's do this. Let's go over from best to not best, because I refuse to call any of these the worst. I want to start with Microsoft, because this one has become completely sainted. Microsoft's doing incredibly well on every single phase of its business. The basic enterprise software product is the strongest I've seen it almost since it started. It's aided by rapid adoption of Copilot, Microsoft's AI product. LinkedIn's just doing really strongly. Their video games selling spectacularly. Azure, the cloud infrastructure division, is outstanding with a huge acceleration in growth this quarter. Finally, Microsoft owns a giant slug of OpenAI and its hugely valuable ChatGPT fundraising round at a $300 billion valuation. Microsoft owns 49% of the for-profit portion of the company. I followed this company for a long time, since it came public, even before then. There's always been one thing, one fly in the ointment, one piece of hair on it. This time the quarter was flawless. Yes, flawless. Next best, Meta Platforms. I am agog at the numbers that Mark Zuckerberg's putting up. The most important one not even talked about on Wall Street enough. 3.5 billion people use at least one Meta product each day. Come on, that's almost half the planet. That's insane. The company's printing money, which is why it can go into the equivalent of free agency and hire incredible talent. But it doesn't even matter. You can't even see it in the margins. You know that if you advertise with Meta, the ads have more reach than anyone. They'll even design the ad for you. And it will most likely outperform any agency-built ad, although they don't knock the agencies in the conference call. Meta even has businesses it hasn't even begun to monetize, because I think it's so busy monetizing others. Who even knows but how much WhatsApp is worth? Mark talks about the Ray-Ban glasses as the best format for pretty much everything, Facebook, Instagram, WhatsApp, and everything else that they have, including AI. I own a pair. Actually, I gave my wife, I gave my kids a pair, I gave my stepkid, I gave everybody a pair. I just give them away. I don't know. I think that these things are so darn cool. And they, you know what? I never thought they could move the needle. But after this conference call, now I'm not so sure. They could be real profits here for this company. Like Microsoft, Meta's buying a huge number of NVIDIA chips for its AI offering, Meta AI. I don't use it much, but you know what? After the conference call, I'll probably add it to the roster. Third, Alphabet. Google Search and YouTube are doing amazingly well. You know what? I thought that Gemini, their AI platform, would cannibalize regular Google. Wrong. It hasn't. Instead, they're complementary. Business is very, very strong, and Alphabet had a remarkable quarter for all divisions, including Waymo, give it its due, which is building a nice lead over the rest of the autonomous vehicles in the space. They Microsoft and Meta are buying a gigantic number of NVIDIA chips, and that's who wins. Next, Apple had a tremendous report, better growth than anyone expected. Those who were worried about a slowdown in the service revenue stream got their heads handed to them. Cash continues to build. After speaking to Tim Cook before the quarterly report, I got the impression that some good things were coming for AI and the perceived weakness. Tariffs, right now, Apple's moved production for most U.S.-bound iPhones to India. But if the tariffs on India really go through the roof because of buying Russian oil, they'll just switch back to China. I'm not concerned. That's right. I'm not concerned. They have the money to do a major acquisition in either or both financial and AI verticals, and I think they're going to do it. Fifth, Amazon. Well, Amazon shouldn't be troubled. It had a terrific quarter, including fantastic retail sales, stunning advertising revenues, decent numbers from Amazon Web Services, AWS. The reason the stock got hit and keeps getting hit is there's a perception that Amazon Web Services growth is slowing. It was flat from the previous quarter, and that's being viewed as a real weakness. I'm hearing that Amazon may be market share donor to Microsoft and Alphabet in cloud computing, and they might stay that way until they stop trying to make do with their own chips and instead buy more, of the ones from NVIDIA. I'm not sure this is a totally true narrative because I think AWS did fine, but I do hear about the resistance from young AI developers who are reluctant to use Amazon's platform to develop their own products. I hope management comes on right here and explains more about this issue. Otherwise, I fear that this is an important position for my Chapel Trust is going to keep getting smoked. Help us, Amazon. I know, I'm greedy. Tesla. As a car company, it's a mess. As a tech company, it's fantastic, especially now that the CEO is being compensated correctly with that $30 billion worth of shares. Mazel tov. I'm convinced that Tesla's worth owning for its autonomous driving and robots, but I accept that the rest of the company's ballast right now. Finally, there is NVIDIA. We don't know how it's doing. It reports on a different cycle, with its next report coming later this month. But we do know this. When you hear that Amazon's not doing well enough because it didn't order enough chips from NVIDIA, like all the other hyperscalers, well, guess who's really the winner? NVIDIA. Here's the bottom line. Even though the Mag 7 has one hand tied behind its back with Tesla, we had tepid reactions to Apple and Amazon's numbers. The fact is, these companies loaded with cash, not outrageously expensive, nation states, I call them, with multiple revenue streams and tight expenses, just can't be beat by any stretch of the numbers or the imagination. Oh, wowza. Let's go to Leslie in California. Leslie.
Jim. Chevron, buy, sell, or hold.
I read that upgrade today. Chevron is win. Chevron is win. Why do we say this? Not just because Mike Worth. Here's put together between Hess and Venezuela. An unbelievable combination. I like the new write-up today that we saw, a recommendation. I am with it. I'm with Mike. Let's go to Steve in Virginia. Steve.
Yeah, Jim, thanks for all that you do. My question is, Colgate-Palmolive had a decent quarter, and they, reaffirmed their guidance. But the stock seems to just keep going down.
Look, the best one in the group, by the way, is Kimberly. Mike Hsu did an amazing job. Kimberly is the right one. Now, I will say this. I thought the Colgate quarter was darn good. I like the Hills. I think Total's doing amazingly well. I don't understand why it's acting the worst of all of them. Maybe it's because of the high multiple, but I would not leave Colgate right here. I just can't. But boy, that's it. Noah Wallace, come on the show. I know you don't like media, but this is the right place to go. Look, right now it's clear that the Mag 7 just can't be dethroned, even with some muted earnings reaction from some of its members. Oh man, buddy, tonight, what's cooking with Shake Shack? The stock fell after earnings last week before rebounding today. I'm seeing investors are getting a rare buying opportunity. Reddit turned engagement into profit. I'm diving into the numbers of the social platform's impressive quarter. And by the way, software company Cloudflare is working to protect your intellectual property from illegal use by AI. I'm hearing all about how the company is policing the internet with the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
During earnings season, when a stock comes in maybe too hot, even a good quarter might not be enough to prevent it from pulling back. Take Shake Shack, iconic burger chain. Last Thursday morning, the company reported a pretty clean top and bottom line beat with its highest restaurant level margins in 6 years, which is what I care about. Yet some people thought there was a fly in the ointment. Shake's same-store sales grew at just 1.8%. Analysts were looking for 2.2%. Give me a break. That's hardly the end of the world. But given that the stock was up 60% from where it was trading when they reported the previous quarter, clearly expectations were high and there wasn't much margin for error there. We have to be careful. But that's why the stock plunged almost 15% on Thursday and fell another 7% on Friday for rebounding more than 3% today. Could this be the pullback we've all been waiting for? Let's check in with Rob Lynch. She's the CEO of Shake Shack. You get a better read on the quarter. And what's next? Mr. Lynch, welcome back to Mad Money.
Thanks, Jim.
Okay, so first, I've always felt that what matters is not the monthly number or the quarterly number, but the cadence. What was the cadence of the quarter each month going into the end?
Yeah, I would tell you Q1 was a tough quarter, and it continued into April where we were down 1% comps. And so we came out of the quarter with positive comps, almost 2%. And we also announced that in July we were up 3.2%. But it's the composition of the comps that really matters. Right. We're moving from a brand that for a long time was dependent upon pricing to drive our growth. Now we're driving traffic growth. It's healthy, sustainable growth.
Yeah, the traffic was up very big in the second versus first. That was really good. Yeah. Okay, so Rob, you took over and you had to make some operational changes. You want it to be better. You're not going to just blow out things before everything's right, but I think you have it now. And one of the reasons why I know that is because we check social. And the social for your company is extraordinary. I mean, even, we've got someone who just had your food on Delta. The Shake Shack burger knocked it out of the park. It's a perfect burger choice for an airplane. I hope it continues past 2025. I've never seen anyone say good things about airline food. You do it.
Yeah, it's pretty remarkable. You know, we worked with Delta for almost a year to make sure that we could deliver the quality that our guests expect when they come into our shacks. So that year was well spent. We've got nothing but really positive feedback. We've gone from being in one airport testing earlier this year to now 13 airports. So we're really excited about expanding that and looking at other opportunities where we can bring the Shack brand and bring quality into places maybe you wouldn't expect it.
Well, it sounds like that you can start putting up a lot more stores, and your stores, each one is very lucrative.
Yeah, I mean, we've really improved our restaurant margins over the last few years. We're almost at a 24 margin last quarter, which is the highest we've been in the last 6 years. So when you're delivering great margins, and we've also taken 10% cost out of the build out for our restaurants. So we're delivering great cash on cash returns for our investors. So we're going to continue building. This year we've guided to between 45 and 50. We're going to hit that. Next year we're going to do even more, and the year after that we're going to do more. We've got our pipeline all the way into 2027 at this point.
Oh, that's fabulous. Now, I do think that people should recognize that there is a value proposition here. Some people say it's too expensive. I say, have you been there lately? You've got some deals.
Yeah, we talk about value for the money. Right. It's not. We're never going to be the lowest price point product out there. It just costs more to make.
But we don't want that because it's made to order.
Yeah, every burger every day made to order. So we're looking at ways where we can provide more value. Right now we're running a $1 drink promotion if you download our app, and that's driving not only more traffic, but it's driving app downloads, which are our most valuable customers.
You have not done advertising, and yet you have a lot of word of mouth. What will happen when you start doing all this advertising?
Well, I hope a lot of good things happen. Right. And, we're starting to dip our toe in the water just the last few weeks, Jim, where we've started buying some paid media. We're really happy with the initial results and look forward to learning, optimizing, and continuing to increase that investment and drive that top-line sales growth.
I know you as an innovator. It sounds like you're doing some pretty good innovation that's working.
Yeah, I mean, our Dubai Shake has been a huge hit. Lots of social media buzz, lots of word-of-mouth buzz, and then we just started advertising advertising it 2 weeks ago, and we're seeing it increase. But we've got a lot more to come. We're really excited about some big ideas we have coming in the fourth quarter, and the whole pipeline for 2026 is already built from a culinary standpoint and a marketing innovation standpoint.
Now, new things just keep popping up. A new place in Atlanta Braves next to the stadium.
Yeah, we're really excited about that. We're actually opening up our second support center in Atlanta. So it'll complement our New York support center, allow us to bring people from all over the globe to our innovation center there. And right down the street, we built our first Shack bar. Boozy shakes, classic cocktails, full bar, complementing our great food. It's been a huge success.
Do you think you can roll it out? Will it work in other cities?
You know, I actually want to build like 100 of them. I mean,
really?
It's so great, but it's got to have the right real estate. Right. It needs to be in the right environment where people are going to come in and not just look for our food, but want to sit down and enjoy a cocktail as well. So we're looking at real estate, but I'd love to build a lot more of them.
I've always felt that you're a coast guy, East Coast, West Coast, Middle East Coast. How's it playing in the great part of the country?
Well, we love all of our guests, Jim. And in fact, as we continue to grow and build more units, a lot of our shacks are showing up in places maybe you wouldn't expect. We just built our first shack and are opening up our first shack in Oklahoma. And we're doing incredibly well. I mean, right now, Dubai Shake we talked about, guess which state has the highest demand for our Dubai Shake?
Florida?
Texas.
Texas.
And Florida's number 2.
I mean, I would not.
Our brand, we've proven plays well across the country. That's why we increased our, a total addressable market up to 1,500 this year. We really believe that Shake Shack can live in every community.
Now, I know a lot of people feel that we know beef prices have gone up. We know it's a challenge, but you're meeting the challenge. You're not taking your pricing up huge.
No, we've built so much productivity over the last year. Right. Our operating margins have gone from right around 20 up to 24%, almost 24% last quarter. We're right now working in our supply chain to find a lot more productivity. So we're able to mitigate that inflation with all the productivity. I mean, we still have pricing power if we need to, if there's enough inflation. So pricing will always be a part of the model, but we're not dependent upon it like we used to be.
Now, I don't mean to be critical, but my biggest problem is that I will wait in line and it'll get at the airport and it'll come too close to my flight and I feel I have to leave the line. Yeah. I know that it's tough to staff some of these places in the airports, but we need more staff or something because the line is a little too long.
Yeah, we're always working with our licensed partners who operate those airport shacks to make sure that, they're meeting our standards. We've been able to significantly improve our speed of service in all of our company restaurants. So we've built the process. We've got equipment solutions. We've got labor management solutions to help solve those problems. So we work closely with our licensed partner. The airport's a tough environment for our partners. We're really supportive of them, but I think we got to get better.
All right, that's the way to go. Now, one last thing. When we talk about price, we hardly ever are able to talk about healthy food. I've regarded your food as healthy, so therefore I'm a little less price sensitive. Mm-hmm. Do others feel the same as I do?
I think most people in New York recognize that Shake Shack came from 11 Madison right. Square Park, and so their understanding of the quality of the ingredients right. is easy. We have to help the rest of our guests across the country who may not be as familiar with our origin story recognize that we use the best quality ingredients across the board, from our beef to our fries to the custard we put in our shakes. We don't put ice cream in our shakes.
No, I know you don't.
It's fresh-made custard in the shack every day.
Well, we all have our favorite places. I've got one downtown in Philadelphia, and I've got one in Brooklyn. We all have our favorite shacks.
Yeah.
And that's because you do such a good job.
But they're all my children, Jim, so I like that. I can't pick one.
I like that. That's the way you keep it that way. That's terrific. That's Rob Lynch, CEO of Shake Shack. I obviously think that this decline in the price is the chance to get in. We haven't had many. Dead Money's back after the break.
Coming up, Cramer's getting online and scrolling through Reddit's recent earnings report. Don't go AFK.
We had a lot of fireworks last week. Earnings from some of the largest companies on earth. Then on Friday, there was the softer than expected non-farm payrolls report, which led President Trump, of course, to outright fire the head of the Bureau of Labor Statistics. So you might have missed it. When Reddit reported last Thursday after the close, the hugely popular online message board shot the lights out and its stock jumped 17.5% on Friday before tacking on another 7% today. That's some move. Even after the incredible move, though, guess what? I got to tell you, I think Reddit's got a lot more room to run. I'm not kidding. This one's been a huge winner for us. I've been following the company closely ever since it came public early last year and started recommending it about a year and a half ago when it was trading around 50. I thought Reddit had tremendous growth, amazing digital advertising business, because it's basically the last bastion of the old school internet. If you have a question about a niche subject, there's a Reddit forum with countless obsessive posters who'll be thrilled to answer for you. And some of the responses are great. At the same time, the whole platform is a treasure trove of data, something that developers desperately want to have access to in order to train generative AI platforms. The only time that I really wavered on Reddit was last December when the stock had run to the 150s, basically triple from where I started recommending. I felt like I was being greedy, so I told you to bring the register on part of your position, but leave enough on that you can keep playing with the house's money. From there, Reddit kept running for the next couple of months, peaking at $230 in January. Then it plummeted all the way back down to around $80 at its post-Liberation Day lows in April. And you know what? That turned out to be an incredible buying opportunity, which is why I pounded the table on Reddit in May. Although by then it already rebounded by to $125. I mean, boom, just like that. Now, for most of July, Reddit bounced between the 140s and 150s, and to me, that looked like a terrific game. But even as someone who adores this company, I had no idea Reddit was capable of delivering a quarter as strong as the one they reported last Thursday night. These results literally were staggering. Much better than expected on basically every line. The company put up 78% revenue growth, much higher than anticipated, and a staggering acceleration versus the last several quarters. There's nothing Wall Street loves more than accelerating revenue growth, and Reddit gave it to you. What's driving the growth? Reddit's core advertising business is on fire, with ad revenue up, get this, 84% year over year, crushing the estimates. U.S. business was up 79%, much better than expected. International up in line, 71%. Not only are they making more money, Reddit's also become more profitable. Their gross margin expanded by 130 basis points year over year, and their EBITDA margin expanded by 1,940 basis points. In the end, the company earned 45 cents per share, more than double the 19 cents that the analysts were looking for. No wonder the stock went up so much. Finally, most of Reddit's key operating metrics, they were excellent. Daily active unique users averaged 110.4 million in the second quarter. That's up 21% year over year, beating expectations. Weekly active uniques were up 22% year over year. Logged in users grew 17%. Logged out users were up 24%. Finally, Reddit's average revenue per unique user, really important metric, was up 47% year over year to $4.53. Analysts were only looking for $3.90. Basically, they've got strong user growth, and each user is making the company a heck of a lot more money. Even better, Reddit issued a robust forecast for the current quarter. The company projecting about 55% revenue growth at the midpoint of their guidance, which is well above expectations. They're also talking about, get this, 102% growth for earnings before interest, taxes, depreciation, and amortization. Again, much better than expected. It's easy to see why the stock, which had already run up 7.5% on Thursday night before it reported, thanks to Meta's strong quarter the night before, tacked on another 17.5% on Friday, even a negative tape, then rallied another 7% today. Overall, the stock's gained over 50 points, or 35% over the past three sessions. It's now back to its highest level since mid-February. And I know it sounds strange, but I don't think it's done. So how did Reddit pull this off? While the numbers speak for themselves, you need to understand the story behind the numbers, because that's the only way to tell if these gains are sustainable, and that's what you need to care about. On the conference call, which was really exciting, I'm not kidding, exciting. Management went into great detail about what's drawing users to the platform, why advertisers keep falling in love with it. First, regarding users, Reddit co-founder and CEO Steve Huffman, a.k.a. Spez, broke down the company's 110 million daily average unique users into two groups. Scrollers, those are habitual users who regularly come to Reddit to poke around, and seekers, who come to Reddit to find answers to their specific questions. 50 million of the 110 million fall into the scroller category and are entrenched users. And the 60 million seekers also find great value in the platform. Because if you got a question and you want it answered by an actual human being, Reddit's the place to go. And it's not just the users who get it, the advertisers get it too. Huffman explained the value proposition here, saying that, quote, as more of the content you see online is synthesized, summarized, and sanitized by AI, Reddit stands out for its honesty and subjectivity. I wish I had said it. I can't say it better. He added that, quote, people want multiple viewpoints and lived experiences. This is why Reddit is synonymous with product and service recommendations. People turn to Reddit when they want to make informed decisions fast, end quote. Anecdotal, Luke, as an advertiser for my wife's Mezcal business, Phosphoro, I think he's absolutely right. I mean, I found that advertising with Reddit is, I don't mean to advertise for advertising, but it's dramatically cheaper than advertising with Instagram or Google. And more important, it's targeted. Reddit is the exact audience that we want. There's a community for everything out on this platform, and that includes people who drink Mezcal, which gives Phosphoro the best bang for the buck. I've looked everywhere for that kind of thing, and I can't find it. Now, clearly, I'm not alone here. As COO Jennifer Wong put it in the conference call, Reddit's ad growth was, quote, driven by broad-based strength across the business, with the majority of our growth coming from existing advertisers who are deepening their investments and retaining their share of spending with us, end quote. But crucially, she added, quote, we also continue to acquire new customers. Total active advertising count expanded by over 50% year over year in Q2, spanning large, mid-market, and small and medium-sized businesses, end quote. That is huge. Everybody's realizing that Reddit is a fantastic place to advertise. It did take a little while, I know, because it's been around for a long time, but it is now it's got, let's say, commercial value. I am a big believer in the AI revolution, you know that, but in fairness, a lot of AI-generated content is slop, as the kids say. Sometimes you just want to communicate with real human beings, and that's what makes Reddit so valuable. Speaking of AI, management's already licensing their data to AI platforms, and they believe this will eventually be a big source of business, although it's still very early. I've been encouraging, I'm saying if you got that, this stock will go up to 300. But they still haven't figured that out yet, I think. Here's the bottom line. After last week's tremendous quarter, I think Reddit might be the best growth story in the digital advertising space, and I bet the stock's got a lot more room to run. So I want you to stick with Reddit. What can I say? I think it's that good a story. Let's go to Ela in California. Ela.
Hi, Jim. Thank you for taking my call.
Of course, Ela. Thank you.
Yeah, and I've been listening to you and really enjoyed the show.
Thank you.
I had a question about Roblox, RBLX. I had bought some stocks when it was at 50 and then sold them back at 100, made some profit. But I was wondering, is it okay to buy at this level again?
I do think it is. I think Dave Baszucki's doing a remarkable job. That was a terrific quarter. I think they could have the breakout year next year, and I want you to be in the story. I think it's really fabulous. I'm glad you asked me about it because it's very hard to find a story that has more growth than Roblox. Very good. All right, Reddit reported a blowout set of numbers last week, and I think it's got more room to run higher thanks to all the tailwinds it's riding right now. Now, there's much more made about it, including my exclusive with cybersecurity company Cloudflare. Talk about a stock that's on fire. Cloudflare wants AI chatbots to stop ripping off your intellectual property, and I'm learning more about its pursuit with the CEO. And speculation has crept into an important corner of the market. I'm sharing when enthusiasm could become a red flag. Not there yet, but you got to know about it in order to call us rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Looks like one of my favorites, Cloudflare, is finally getting its due after the cybersecurity company reported an excellent quarter last Thursday night. Only to see its stock sink 3.6% on Friday. It was dragged down by that broader sell-off. Today, though, Cloudflare snapped back, up more than 4%, which makes perfect sense because these guys delivered a clean beat and raised quarter with better than expected numbers on every line for the quarter and truly strong guidance. Initially, none of this seemed to matter, but with today's rally, the stock's now sitting at its highest level in nearly 4 years and within spitting distance of its COVID-era peak. So let's take a closer look at Matthew Prince. He's the co-founder, co-chair, and CEO of Cloudflare. To learn more, Mr. Prince, congrats on a strong quarter. Welcome back to Mad Money.
Thanks, Jim.
Okay, so Matthew, you did see an acceleration of revenue growth. We do not see that very often. You also hit the $2 billion mark. What is behind the strength? Because it's truly pretty incredible.
Well, I think the first thing is our team. We have just a world-class team that has come together to take Cloudflare from what was traditionally a product-led growth company to today a true enterprise-class machine. So I know you know Mark Anderson, who used to run Alteryx, now is running Cloudflare's go-to-market team. He's just made an incredible transformation where we are speaking to the largest companies in the world and delivering all of their cybersecurity needs and their network security needs.
Now, I know it's not very lucrative, but I got to go into this immediately because it's just so important. I have been a big believer, having started TheStreet.com, by the way, which is one of your customers. I look at what's going on and I say, you know what? There's a power grab being done by these big sites. Like a Perplexity, for instance, and they're getting away with murder, I think, because if we don't protect content, then no one's going to develop content. Probably 85 to 90% of my content was to Google and then Google back to me. You're the only firm standing up for the individual journalists out there. Can you tell us how that works, how it's working, and whether you can stop what I regard as theft?
Yeah, I think that people get this confused, but the internet has never been free. The web has never been free. Someone has always paid for it. And for a long time, that was search engines that sent you traffic. And then you, as a content creator, could get value from that traffic from either selling ads or selling subscriptions, or even just knowing from the ego of knowing that people were reading your stuff. What's happening, though, is the world is transitioning from search engines to what are today answer engines. They aren't sending back traffic. And so just because you had a deal with Google where they got your traffic for free in exchange for sending you traffic, if they're not giving you anything back, then they have to do something else to compensate you. Because journalism, academia, researchers, they all need to eat. And we need some way to make sure that they are getting compensated for the incredibly hard work that they're doing. And so in the past, it was Google that was the great patron of the web. But in the future, it's going to need to be the AI companies, which will increasingly be the interface of the web. And we've got to find a way for them to compensate journalists like you who do incredibly hard work and are giving the original content that is the fuel that runs these AI engines.
Well, I got to tell you, Matthew, one of my favorites that I use constantly, I use Perplexity. I read your blog today, and now I feel like, wait a second, maybe Perplexity is a bad actor.
They have been an incredibly bad actor in this space. They have been doing things that I think are most closely resemble what the North Korean hackers do when they try to steal content or hack different sites online. If you tell them that they can't get your site, they go through all kinds of different tricks and deception in order to try and get your content, which you created. And so what we need to do is say that it's not allowed. If you say that they can't have your content without paying you for it, then they shouldn't be able to steal it out the back door. And the great news is that Cloudflare is incredibly good at stopping the North Koreans and will be incredibly good at stopping Perplexity too.
Well, I feel I've already devoted too much to the... No, I didn't. I think what you're doing is unbelievable. So I didn't devote too much time to it. I did want to talk about Shakespeare. You are an English major. You've got, the Shakespeare's 5 acts. You've got a bunch of, I think that you're going to have to go into I think it's going to be Henry IV part 1 and 2 when we're done with this, because there's way too many acts that are ahead of you. But tell us where you are in terms of Cloudflare's development.
Sure. So, Cloudflare started with a simple idea, which was, could we put a firewall in the cloud? What we needed to do in order to support that, to have the data to have it, was make it available for everyone for free. Once we did that, that gave us just an incredible set of problems that we needed to solve, both for ourselves and for our customers. And so, Act 1 we think of as our reverse proxy products. Those are things like web application firewall, DDoS mitigation. Act 2 are our forward proxy firewall products. Those are things like VPN replacement, zero trust, SASE. Act 3 is our developer platform, which has been just wildly successful. And today, as we're helping content creators make sure that they can get paid and that the business model of the web continues to exist and evolve, I think that's going to be the 4th act of Cloudflare. And as you said, I'm a recovering Shakespeare English literature major. Don't hold that against me. But we think we have still a lot more up our sleeve. Every one of Shakespeare's plays was at least 5 acts long, and I would
never hold it against you. I love Shakespeare. Now, I do say that a lot of companies come on, they've got a land and expand strategy. The amount of business that you get after you're in is far in excess of almost every one of these land and expands who come on. Tell people what happens. You get in, and then people just like what you do, and then you get really big contracts.
Yeah, that's exactly right. I think we have always made it said that we would make it available for anyone, and whether that's an individual developer or a small team within a larger organization, we tend to solve an immediate problem and then build a relationship. And what I think Mark Anderson and the team at our go-to-market team have done is really say, we don't just want to build relationships with the individual practitioners, but increasingly I'm spending my time with the CEOs of the world's largest companies and saying, if you have a network security problem, if you need to have a faster network, if you have to have a more reliable network, and everybody does, Cloudflare is the network that is going to be there and is going to continue to innovate and deliver for the future.
Now, people need to know, I think you have more exposure worldwide than any other outfit that does what you do. You're everywhere, right? I mean, there isn't a part of the world that you don't cover.
No, we're in over 120 countries around the world, in 300 and some odd 60 some odd cities around the world, thousands of data centers where we're putting our equipment directly in. And what that means is that wherever you are, whatever product you're using from us, we can make sure that it's fast and reliable. So if you have a CEO who travels extensively and you're getting complaints about how the VPN service is really slow when they're, visiting the gorillas in Rwanda, we have a data center in Kigali where we can serve that CEO and make sure that no matter where they are in the world, we can make sure that they're fast, reliable, and secure.
Excellent. Well, anyway, Matthew, I'm so glad you got your due. It was a really incredible quarter. People should read this conference call because it's really one of the best disposition of what I've seen of the way a company can grow. Matthew Prince is co-founder, co-chair, and CEO of Cloudflare, one of the great growth stories out there. Thank you, Matthew.
Thanks, Jim.
Mad Money's back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It's time for some of the white brown for one of these things. I'm saying bye. So don't know the course. I'll credit that time. I stand for this. Please go ahead and play this now. And then the lightning round is over. Are you ready, Ski? Tongue white round crazy. Let's start with Barbara in Texas. Barbara.
Hey, Jim, second time caller. I love you, man. But the pain. I bought this stock at a high of 411, figuring, the CEO or the owner is such a genius. We'll be back up above this right away.
And the stock, which one?
Tesla.
Oh, hey, look, you're fine, Tesla. Tesla's morphing right now. It's in transition from being a car company to being a technology company, and you want to be in there because the tech is worth a lot more than what it's selling for right now. Don't worry, care where you bought it. I care where it's going to. Let's go to Chris in North Carolina. Chris.
Cramer, club member, big fan, first-time caller here from Winston-Salem, North Carolina.
Let's go to work.
And I want to know your thoughts on Accenture ACN.
Accenture was one of the worst acting stocks in the on Friday. I can't believe how poorly it's doing. I'm not going to get behind it until we find out what the heck is really going on there. Let's go to Mark in South Carolina. Mark.
Booyah, Jim.
Booyah, Mark. What's happening?
Thanks for taking my call and for making stock analysis available for us home gamers.
That's
my question for you? Yeah, definitely. My question for you is, with the recent recalls and rising costs of raw materials, is Ford Motors still a buy? Or
the stock acts better despite that bad news, which I like. However, I will have to say that if they don't get that warranty stuff down, it is just too tough to recommend. How about we go to Frank in California? Frank.
Hey, Mr. Kramer. I'll make this quick.
Sure.
I've been holding on to this stock for a while now, and I'm going mad because it's doing nothing. But I really believe in the company. I'm talking about Target.
If you believe in the company, you like shopping there, it's got a good balance sheet, 48% yield, then you're free to buy it. I happen to like TJX and Costco. TJX breakout move today. Let's go to Paul in Ohio, please. Paul.
Booyah, Jim Cramer.
Booyah, Paul. Hit me again.
With their earnings coming up in a couple weeks, should I hold, sell, or buy more Snowflake?
I like Snowflake. I think you can buy more. I honestly do. I think that the quarter is going to be a very, very good quarter. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, Cramer's identified a new type of meme stock in this market, one that's ringing a bell with investors. He's revealing what it is. Next.
Booyah for the Emperor of Cramerica.
Honorable James J. Cramer.
You got me jumping around my office right now.
Thank you so much for all you do for us.
I enjoy your show and I find it very entertaining and informative.
I watched your first ever episode of Mad Money back in 2005, and I've been watching every single episode ever since.
Don't miss Mad Money every night at 6 p.m. Eastern. Plus, join the CNBC Investing Club and stick with Cramer around the clock.
Market darling Palantir Technologies reported a spectacular quarter after the close. Much better than expected revenue, up 48% year over year. 2-cent earnings beat off a 14-cent basis. Management raising their full-year forecast dramatically. Company's Rule of 40 score, which combines the revenue growth rate with the adjusted operating margin, came in at 94 for the quarter. I've never seen anything like it. It's no wonder this already red-hot stock could surge in after-hours trading. And look, I get Palantir. It's among the most popular stocks in the universe. Alex Karp is one of the smartest, most perceptive CEOs I've ever met. His team is amazing, and the contracts he accrued are incredible. But his stock, it's overvalued versus any metric that I can find, the least of which may be earnings per share. It sells at something like an astounding 277 times earnings, and that was before this quarter and tonight's after-hours gains. I accept that. Sometimes you have to pay too much for a real spec. Remember, we have two markets going here, the normal one and the super speculative one that's made up of various cryptocurrencies and the stocks that back them, along with flying cars like Joby Aviation does an acquisition. It's not even that good, and the stock goes up big. Nuclear power, data center, and, of course, Palantir, which I, again, bless, okay? But of all the speculation we're seeing here, nothing repulses me more than the red-hot IPO market, because when IPOs get too hot, they can lead to a bull market slaughterhouse. Right now, IPOs have become the new meme stocks, and the investment banks doing the offerings don't seem to know it. The meme trend began with CoreWeave, which came public at 40, incredibly small float or amount that was offered for trading. The underwriters, anxious for the deal to work, priced it in the hole, or way lower than they thought they would have to do, and then they downsized the offering, selling just 37.5 million shares, raising just $1.5 billion. They originally hoped for something that's $1 billion more than that. Now, CoreWeave is worth over $50 billion. The stock was initially driven up by memesters who knew there was no new supply, so they just kept buying and buying and buying. How do I know this? Because it's a pattern that I've seen since 1998. I recognize it. CoreWeave, a data center company, was simply very easy to take up because there wasn't much supply, especially if the deal was downsized. I'm a huge fan of the business, but the stock's pretty expensive. Next up, the larger deal was Circle Internet Group. The IPO market was starting to heat up by the time Circle came public in early June. But even though Circle upsized its deal significantly and raised its offer price range and then still priced well above the high end of the range, it wasn't ambitious enough. Deal price at 31, but the stock opened for trading at 69. Within 3 weeks, it was nearly at 300. It's since cooled off around, they come down to 165. But that's still probably way too high. I think winners from CoreWeave rolled their take into Circle and turned it into a meme stock, which brings me to the last meme stock I'm going to talk about, Figma. Here's a deal of roughly 37 million shares, only a third of which were offered by the company. The rest came from investors and insiders, priced at 33. Definition of suboptimal based on the trading in CoreWeave and Circle. Anyone who follows the market as closely as I do, and the people who do these deals should follow them more closely than I do, had to know that the hot money was going to go to Figma. The deal raised $1.2 billion. Company's now worth $43 billion after the stock plummeted today, but it was valued at $70 billion at its peak. That's just crazy town. And I'm sure the bosses are going to ask the people who came up with that pricing, what were you thinking? Didn't you know that this new level of hot money will pay anything? Anyone who's been around for more than 20 years knows that these IPOs are now part of a speculative bubble, and no professional wants to be culpable for igniting this free-for-all. You could say, who cares? Everyone's making money. What's the problem? I come back and say, don't we wish that the dot-com bubble hadn't happened? Don't we wish that the 2022 meltdown hadn't happened? It was stuff like this that drove it. The syndicate desks were clueless to what was really happening. I know syndicate desks can't tame speculation, but they should know when they see these incredible doubles from the first day that the coloration has changed, and they shouldn't stoke the gamblers or throw their hands up and just say, hey, there's nothing we can do about it. That's not what we want. Instead, we want investing, and we want to make money. The Circles, the Figmas, the crypto stocks, they're all what's wrong with the market, not what's right. The syndicate desks who do the pricing need to know that once there's more wrong than right, this bull will turn into a bear, and their earnings at their companies will go up in smoke. I like to say there's always a bull market, so I promise to find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.